Back again with another episode. You feel me? This part two of Real Estate Talk the Talk. See, we about to get in today. We got a lot of different terminology for y'all. You feel what I'm saying? Once y'all hit that subscribe button, hit that bell for y'all can be notified for when I drop my videos. You know what I'm saying? So what we gonna talk about today? Basically, what we talking about today will be what is mortgage and what is equity. In this video, we're going to talk about cash flow, loans, mortgage, and equity. You know what I'm saying? We're going to talk about rent and leasing too. Basically, it's a mortgage is basically a legal agreement by a bank or a creditor that lends out money at an interest rate in exchange for taking the title of the property, basically. So, we're going to go on the next slide here. Okay, first thing we're gonna talk about right now is house loan. You know what I'm saying? Say you don't have the $200,000 for the house, the bank would buy out the house for you with an agreement for you to pay it back, and which is normally a monthly payment. So that would be what is called a mortgage. It would be your payment would be out in a mortgage monthly. They would decide a set amount for you, whatever you owe have left, to pay within a 30-year agreement. Normally for your first time, within the 30-year agreement, you feel what I'm saying? You would pay out for this house. Okay, mortgage and note is basically the same thing. A mortgage is a debt instrument secured by the controllers of specific real estate property that the borrower is object to pay back with a predetermined set of payments. So they basically just gonna set a note for you. Basically, here you go. This note right here saying you owe, say, $1,000 a month for this house. As long as you pay this $1,000 back, we have no problem. You feel what I'm saying? We just pay it back monthly until it's paid out. That is your note. So your mortgage. Mortgage note, same thing basically. Mortgage just saying it's the note on the house. You feel me? Note is for like anything. You have a note on the car. Alright. Rent and leasing. Rent and leasing. So basically you can lease out your home or rent it out. So it's a tenant regular payment to a landlord for the use of property or land. If your mortgage is $1,000, you can rent out your home for $1,400 a month and make a cash flow of $400 a month while building your credit. So cash flow. Cash flow is the amount of profit you bring in each month after collecting all income, paying all operating expenses, and setting aside cash for future repairs. You feel me? So basically you can use that cash towards your house come or whatever, and this is another way to create a great passive income. So I mean cash flow comes in handy while you trying to get that equity on your house. You renting out your house through periods of time, you getting that consistent flow of cash. So right here, equity. Home equity is the market value of a homeowner's. So basically, it's the value, the balance left from what you owe the bank and what the house is valued at. So whatever you can sell your house for and what you owe, you can hurry and pay the bank off, sell your house. Whatever you pay the bank off for the rest of that on top, it would be extra money on top, and that would be your equity, basically. So equity is the difference in what you owe on mortgage and the value of the house. So 5 years passed, you bought the house at $220,000. The house is now worth $300,000, and now you only owe $150,000 to the bank for the mortgage. The difference is $150,000. So you would sell your house The equity, if you would sell your house, the equity would be $150,000. So that's basically what equity is. It's the top off of what you owe still left to the bank and what your house is worth. So if you want to sell your house today and pay off the bank, say you don't want this house no more, sell it today, whatever the house is worth and you can sell it for, that would be your equity. So somebody would talk you down from, you know what I'm saying, $300,000. Say they bought the house at $2,800,000. I mean 2,800. Yeah. $280,000. So they bought the house at $280,000. Your equity would be, and you still owe $150,000. So your equity would be $130,000 instead of the 150. So that's just an example. Say if they be like, no, I don't want it for $300,000. You know, I want it for $280,000. Then that would be your equity. Thank you for watching the video. It's the end of it. Please hit that subscribe button and tune in for more videos.